Yesterday, we have discussed about the few concepts. That is, we talk about business entity concept. As per this concept, every business and its owner, they are two different peoples. Then we discuss about the next concept, that is going concern concept. As per this concept, the organization is continued throughout the journey and its existence is not dependent on a particular owner or person. Then we discuss something called as money measurement concept. As per money measurement concept, everything in accounts is need to be calculated, measured, evaluated in terms of money. Then let's start understanding the concept called accounting period concept. Now this period concept is divided into first accounting, second period, and third concept. Here, accounting indicates the writing of accounts, maintaining of records, and tracking down all the income and expenses in a particular format. So, accounting period concept talks about recording of various income and expenditure related to business in a particular systematic way. Here, period indicates a duration. The period indicates the period for which the record of transactions or record of change in debit or credit balance is recorded. So, in short, in accounting period concept, the details of account are maintained and recorded. Now, the third point why I highlighted concept is this is a predefined. Now, why it is necessary to predefine? Because if I'm not defining what is my accounting, what is my period, and what is their interrelation, simply I am losing my opportunity. For example, suppose my financial year starts in the month of Jan, and if it ends December, then the person who is reading my accounts, he should understand, he should able to focus, and he should able to recognize what is my start and end, because this will give an idea that for which I recorded the accounting. Suppose I'm maintaining the 3 months accounting records, then from that records, I cannot expect the whole year data. If I'm just giving the quarter data, so quarter means a 4 month period, then certainly I'm not able to analyze the other data. So comparison, analysis, evaluation, this all is feasible if and only if the period is mentioned. So to measure the financial performance, to measure the financial influence, what we do is called as accounting period concept. Now my PPTs got corrupted, so the things are not showing correctly. Just give me 1 minute. Now, in this case, the accounting period is a duration. It can be of 1 month to 6 months. It can be from 1 month to the 15 months and so on. So, accounting period concept defines the duration for which I am writing it. Normally, from 1 month to 12 months, whatever the income expenditure I do, they are called as a year, and the expenses are recognized as revenue expenses. So 1 to 12, it's a revenue. If I'm recording the transactions which are more than 12 months, but up to 15, then it is called deferred revenue. And the transactions which are extended beyond this period, they are called as a capital expenses or records. So 1 to 12, it is a year, which is called revenue. Why it is called revenue? Because it is recorded in such a way that the transactions plus or minus, they are outcome of the financial year, and hence they are called as the revenue expenses or revenue gains. Whereas if the transactions are more than 12 months, that is one financial year, they are called as a deferred revenue expenses. So they are not capital, but they are revenue, but not capital. So between revenue and capital, if anything additionally done, it is called as a deferred revenue. Whereas if more than normally 18 months or more, if the period of accounting is concerned, then the transactions are recognized as capital base. So the period concept helps me understand three things. One, what is the duration for which the records are maintained? Second, it gives me the comparison. It helped me to compare the particular period because if it's annual expenses, I can compare the annual details. If it's a monthly, I can compare monthly. So it talks about period. Third, it gives me an idea what is nature of expenses so that recording of it and understanding the impact, it become very clear. Siddhi, I'm conducting session. Please keep your mic mute. So this period is very crucial to understand effect, to understand the recording, and to recognize what are my income and expenses. Now, what happens if I do not have a period concept? Then it might possible I'm not happy about numbers, so my lucky number is 5. So I start with the number 5. So my month start with the 5. Another person will start with the month 10. Another person he start month with, on 27th. Then how I'll compare the data? There will be no uniformity for comparison. Secondly, I'll not understand the good thing and bad thing because I'm not able to compare. And so if I want to invest, I want to take any financial decision, it becomes so complex. Secondly, if I'm writing books of accounts, it's a going concern. It is continued from one financial year to the other. But even though it's a continuous activity, I need to manage my transactions. I need to record my transactions in a such a way that they are benefited, they are being analyzed, they are being recorded in most appropriate and correct way. If they are not properly recorded, if they are not properly mentioned, then in such case, these records are not giving that impact which they're supposed to be. For example, calculating depreciation. If I'm not calculating depreciation in particular period, then the depreciation for 12 months and depreciation for 18 months, I start comparing and it will lead to a chaos situation. And that's why accounting period concept is very crucial and essential. So when we are writing the accounts, it helps to compare, count, and verify the books of accounts if I am understanding the duration, which is called as a accounting period. Let's go on to the most important cost concept. Now, as per the cost concept, I'm talking something about the cost. The cost is a base price. Cost is that actual expenses which are recorded, which are maintained for a particular purpose. When we say cost, we are talking about the base price which we have paid. We are talking about the amount of expenses which we have incurred and which are the must minimum charges I am paying. So in cost concept, we are recording the transactions. We are ensuring that each transaction is compared with its value, and whatever the value, less or more, that value we have to compare. Now, accounting, all of you know, it's a continuous activity. So we always consider past continuous pains because we are going to concern and create an impact of old activities for now. So in accounts, we are never settling accounts. We are never closing an accounts. We are always carrying out the effect of this year balances, or we are carry forwarding the balances of last year for this year. So we are maintaining the accounts on historical cost basis. When we writing the accounts, we ensure the price of product is recorded properly. Why? Because if the extra price is charged, it will lead to more profit booking. Ultimately, more tax is welcome. To give an example, suppose the base price is 555. There are two cases. Suppose in 2011, if the price remains same, then there is no doubt I can select any price. But if the market price is 250 and cross price is 255, then I need to compare these two prices, and normally I prefer the price which is lower. Reverse side, suppose this is the price triple five and this price becomes 700, then I will record the lowest price. Why will do this? Give me an example. Suppose this is a balance sheet. I record the price 50. The effect of this 50 will be on my profit and loss account. This effect on my profit loss will increase my profit. So earlier, suppose 100 was the profit. Now the 50 addition will be there because the credits are increased. So my profit will become 150. If profit increase, indirectly the tax will increase because earlier I'm paying tax on 100, now I'm paying tax on 150. So this will attract more tax. Secondly, when you do the valuation of anything, we always believe the valuation should be done at realization cost or at the cost where the assets I'm holding is giving true figures. Now, for example, if the market price is too high, why I'm not recording market price? Because market price is booking my profit also. But in case my historical cost is high and market price is low, why I record the market price? Because that will help me for my actual profits. That will give me my correct figures. So even though we follow in historical cost method, we need to always compare the cost price and market price and we'll record whichever is low. Number one. Number two, cost is something which is inclusive of all. Now, what is inclusive of means? Suppose I'm buying a fan, then the cost of fan will be equal to the basic price of fan plus its installation charges and plus any other transport or packing charges applied. For example, basic price of fan is 5 rupees, installation charges are 1 and transportation is 1. Then the cost of that product should be 7. Here the price is not recorded as 5, but we have to record the price as 7 because that will give me the exact price which I have paid or I am paying. So this is the difference between the pricing mechanism. Again, when I'm doing the pricing mechanism, I should also understand the price which I'm charging to any product should be related. For example, I purchase a fan of 5 rupees. I spend 10 rupees for the person who is delivering his petrol expenses. I paid 5 rupees for his movie tickets. Then I should able to recognize what are the related expenses and what are unrelated expenses. Doing his social welfare or helping him for relaxation cannot be directly included in a cost. If suppose a person is delivering 10 products and total cost of 10 products delivery is 1000, it means the cost of delivery per product is 100. So I should recognize that cost per unit. So division of cost as per quantity. Second, division of cost as per comparison is analyzed based on all this. So in short, when we record the cost of products, we should also add its delivery, maintenance, or installation cost, which is related. And if the quantity of products are sold in bunch and valuation is done on individual basis, then per unit costing should be properly done. So far, any doubt in period and cause concept? If any doubt, you can unmute and speak, or you can post in chat box. I'll wait for 1 minute. Anybody has any doubt? I think no doubt. So let's move further. Dual aspect concept. Now, in this concept, again, there are two things. This aspect says dual and aspect. Now, what is meaning of dual? The dual means two, and here aspects means impact. So, dual aspect talks about the two effects, two impacts of one accounting transaction. In accounts, we never should record a transaction on a single side. Each transaction, each expenses, or each income should be recorded twice. A single record will indicates inappropriate. Why? Let me explain in further. In accounts, we have two sides. One is the debit side and second is the credit side. So all of you, if remember the first semester, when you writing in accounts, we have equation where we write debit and we write credit. Every debit should have an equal credit. If the debit is not available on equal sides, then we can record 100 as a debit and then we can record minus 100 on same side indicating the reverse effects. So the transaction which is done, they are normally completed on accounting principles. So as per accounting principles, if I'm recording a transaction, I should think about two things. One, there's something is coming in and something is going out. If you remember the Contract Act, it says the transactions or the contract is valid if it has a valid consideration. The consideration may be anything. It can be a pleasure, it can be a thing, it can be money, or it can be a combination. But if there is something, it happens. Now, if you remember simply the real account principle, it indicates debit what comes in and credit what goes out. So it means I have two sides. Suppose these are two different people we can call as a person A and person B. If A is receiving something, it means somebody is giving to A. So B is giving to A. So if B is giving something to A will also give something to the B. So if I'm doing account writing for A, then for A, B is the giver and B is the receiver. They will do the transaction if they interchange something. So suppose he interchange goods for the cash. So B will give him the cash and A will give the goods. So two things, two accounts are always making an impact. For each account transaction, there are two people, two entities, or mix of these is always introduced as having effects. And please remember, in accounts, when you're doing the financial analysis, this is a crucial example to understand the each transaction. Now, this will more clear. I'll wait for 1 minute. You read the slide, then we'll explain. Now, if you see, the cash sale is rupees 10,000. What does means? The cash is received for sale of 10,000. Now, sale means I'm giving some goods, some products, or some service to the other person, and because he takes my service or my products, he is giving me the cash. So here we have two effects. One, a cash, and second, a sales. And what is the relation? I have money measurement of rupees 10,000. So debit what comes in, real account principal, so cash account, and what goes out, it can be sales or sales account. So the transaction is having two effects. One is the debit and other is credit. And then I mention the amounts. Now, why the transaction has two effects? Because a business is a separate entity. So when I'm dealing with a business, I'm thinking about something I'm putting in and something I've taken out. So for my each action and for my each reaction, there are meanings, there is understanding. The transaction is happening for what it is. So this way, the each transaction is recorded twice. Now, what happens if I ignore any one effect? If I ignore any one effect, this will be resulting into partial recording of transactions and it will make an impact of incomplete accounts records. Now, why it make an impact of incomplete? Because if I had to record a valid transaction, then the incoming and outgoing or debit and credit, the accounting principle should be recorded. If it is not recorded, then I am only writing the accounts in partial way. And when I'm recording the accounts in partial way, indirectly, I'm recording in half. And this will lead to the mismanagement or creation of suspense accounts. And when you have a doubt or suspense account creation, it will create a chaos and uncontrolled situation which is not expected in accounts. Let's take an example. Purchase from Ram goods worth rupees 20,000 at discount of 2,000. Now, in earlier transaction, we have a exact effect. In case of earlier transaction, we have only two accounts. One is a debit and second is credit. This is called a plain transaction. Now, what is different between this and above transaction? Here we have a cash and sales account. Only two people are there and they are dealing with the expenses. They are dealing with the one equal to two. But if suppose the transaction like this, where the transaction has three effects or four effects, then we can have two separate entries. And also we can have a single entry that is we call as a combined entry. Now suppose in this transaction, I want to write a clear entry, purchase from Ram goods worth rupees 20,000, right? Discount received 2,000. What does this means? I had done the purchase of 20,000. Now, so purchase account debit 20,000 and to the person who gives me Ram's account 20,000. So this will be my first entry. The second entry is about recording the goods, recording the everything because when I'm paying, I'm talking about sale. So what I'll do is the entry which I will pass is Ram account debit 20 to discount 2,000 and two creators 18,000. So now I'm transferring Ram account to creators account. If here I remove the common things, so it is Ram and Ram. When I combine this, I can write my entry as purchase account debit to discount and two creators. Now, in this case, since there is only one creator, instead of writing creditor, I'll write Ram account. And so I have the entry purchase account debit to Ram account and to discount account. So the 20,000 debit has equal 20,000 credit. It can be by way of single entry or it can be way of combined entry. But the effect of debit and effect of credit should match. Or in other words, the amount of debit side and amount of credit side should be same. We just simple cannot write on debit side 20 and credit side 18 because this will lead to mismatch. And anything mismatch in two effects, we create a suspense account or chaos in accounting. And that's why we always need to remember that in accounts, we have two effects. One is a debit effect, and second is a credit effect. So every transaction has to be recorded twice. And because of this accounting concept, we have something called as the accounting equation. Now, what is accounting equation? Accounting equation here talks about the total of asset side is equal to total of liability, or total of assets is equal to capital block plus liability. So if your financial accounts are tallied, then it is indicated that your books of accounts are maintained or recorded in particular format, or they are recorded in a format in such a way that the arithmetical accuracy will be verified. If suppose in accounts we have one more statement which is called as a trial balance. No, anybody know difference between the two things? Trial balance versus balance sheet. Anybody know the difference between these two documents? You can unmute and in update. What is the difference between, I think I have done a mistake in trial spelling. I'll rewrite. What's the difference between trial balance and balance sheet? Anybody? Just remember your first semester. What is the difference between trial balance and balance sheet? Let me give an example. As the name suggests, or as the name indicates, the trial balance, we are recording the trial accounts. And in balance sheet, we are trying to find out the balance between assets and liability plus owner's equity. So trial balance is a mere statement to record the summary of transactions, where my purpose is to just record a debit and credit and check the balance is matched. For example, debit side it is 50, then my credit side should match as 50. So this is what I do in trial balance. So trial balance only observes arithmetical accuracy, whereas in financial management, the balance sheet contributes towards checking the errors of commission, omission, and principal. Now, what is a commission? Commission means add. Instead of writing in X account, I'll write in Y account. So even though I write in wrong account, in trial balance, it gets tallied. In case of trial balance, the achievements is maintaining a summary, maintaining a proper names, titles about what accounts I'm maintaining. Whereas in balance sheet, I'm following the principles, I'm following the logic for recording the transactions. So in trial balance, only the numerical values and their sequence or summarization is done. Whereas in balance sheet, I have a proper structured format, a methodology where I'm recording each transaction. Trial balance is not meant for accounting concepts because it's only summary recording, whereas in balance sheet, I am properly following a guideline, a benchmark to record and transactions. So in this case, we always should remember that the trial balance is meant for only analyzing summary of accounts, whereas the financial accounting, when we write everything by principles, by logic, it is always being related towards all errors of omission, commission, and trial balance. So A trial balance is a summary, whereas balance sheet is a statement which denotes each summary, each process in a systematic way, in systematic methods to present the actual fact sheet with all accounting logics and methodology. So, dual effect or dual transactions I can enjoy in a financial management by analyzing a balance sheet. I can see the dual effect in trial balance, but this dual effect in trial balance is only arithmetical accuracy. Now, any doubt about dual entity concept? Because in dual entity concept, we have three things. One, every debit is equal to credit. We follow an accounting equation where each side of debit has equal effect on credit side, and this is logically followed in writing the impact or equation of anything. Secondly, when we're writing the accounts, we need to understand that the mismatch or error of omission, commission, and principal should be avoided by considering the two effects. Writing only one effect will give the arithmetical accuracy in trial balance. But when I'm writing the final accounts, it should maintain as per the principles of account. Any doubts so far? Any doubts so far? I guess no doubts. So let's continue. Now let's talk about the next concept, relation concept. Anybody know meaning of relation concept? Anybody know the meaning of relation concept? Okay. My dear students, if you do not speak or do not contribute, it will become monotonous. It will be like I'm just sharing the thoughts, and because it's pure more theoretical subject, it will not be a learning. So try to contribute. The relation concept talks about how much value or how much profit if I'm writing an accounts and I'm not able to understand the price or the cost. Now, When we're talking about the cost, we have said we have to compare the market price and cost price. When we talk about money measurement, we are talking about the everything is valued money. So when we're talking about the price of any goods, we should talk about the benefits which we receive. So profit is earned when the goods or service are provided or transferred from one person to other. Thus, when we want to record the profits, we always should remember the benefit or the value which I have received. So, what is relation concept? As per this concept, suppose I'm selling 10 mangoes. Now, basically, mango is grown on a tree. For that one tree, I'm giving some water, I'm giving some pesticides, I'm giving some fertilizer and all. So, I'm not clear about how much water I'm giving or something. So, if I take a mango from a tree of my own and just eat it, there is a no price. But actually, it has a price. If I consider that mango t- total farm and the owner is different, then what is the market price or what is the price of expenses cumulatively I have paid? They will accumulate it together as its cost. But in case I am not noted the expenses, then whatever the price paid by the customer or a consumer is considered as relation value. In short, the amount which a person is giving for use of goods and service is the price of that product or service. For example, I have a old fan which I sold for 10,000. I have buy it for 5,000. Now I buy it for 5,000. I sold it for 10,000. Here profit is 5,000. I'm not interested in profit because profit is recorded in the books of account for a different purpose. Here, when I have sold the fan, one fan is costed me 10,000. So I'm getting 10,000. So whatever the things I'm getting, it is my realization. Take a second example. We have a mobile and we want to exchange the mobile. The price of mobile is 1 lakh. But when I go for exchange, I never get the same price. So at that time, whatever the other person is willing to pay is called as a relation value. I cannot simply decide what is my value and how much I'm going to pay and how much I'm going to consume. I need to simply understand the value which is paid by the other person is cost of that fan. So, as per relation concept, if you're not sure about the expenses you made for a product, then whatever the value is given by customer or consumer is called value of that goods and service. To be very precisely, if I'm selling a milk and I don't know the price of milk, so what I can do, I can refer the similar product in open market and based on similarity, I can take a call what will be price of my milk. Second, I can refer to an expert and understand what will be the income if I sold the milk. He will advise me, okay, sir, you will get 100 rupees, you will get 50 rupees, you will get 60 rupees. In short, he will understand what is the price of my product and what is the value the customer is going to pay. And whatever the value customer is paying is called realization value. To more clear, suppose I have done an innovation, I come with the new product, and I cannot compare or I cannot bargain in a market because this type of product is not existed. Now, in case this type of product is not existed, then The goods cannot be have similar products. Then what I'll do is I will go in search of similar services. If not found, I will approach to the evaluator and what is the price he decide. I will do it as my price of product. Number one. Second, I will keep my product for the targeted customers. Whatever the price the targeted customer pays, I'll consider as realizable value. Or third, I will appoint the government evaluator and he will value my product and based on that, we'll understand and he will decide, okay, price of this thing is this. So whatever the decided price is called as a value of realization. Now, why so value is important? Because when I'm performing some act or producing something, I'm not sure what is its cost. So while writing the profits or loss, I should able to take a judgment call whether I'm making profit or loss. So as per accounting standards, I need to take value of similar products in the market or the price from products which are performing in same domain in the market. So in short, the amount which I'm able to realize, the amount which I'm able to take or get as a benefit is equal to the value I should record. If I'm selling a pen for 100 rupees, then the cost of that pen is 100. If the customers are buying that pen instead of 100 in 1 lakh rupees, then cost of that pen becomes 1 lakh rupees. If the customers are willing to buy the same pen of 100 rupees in 30 rupees, then the price of that pen is 30 rupees. So I have the pricing. I have different methods of pricing. Like in marketing, we have lead pricing, uh, penetration pricing, brand pricing, and so on. In finance, we have cost plus pricing, profit pricing, markup pricing, and so on. But unless the customer paying value, I cannot record the price of that product. Let's move further. Matching concept. Now, you would like to answer what is matching concept?
What we display in books of account should match the record. Like if I'm saying that I have 50 machines, then I should actually
Hmm.
have.
Partially, you're right. Now, we discussed something about a relation concept and dual aspect concepts. We talk about dual aspect, we talk about relation concept. Can anybody try using these two concepts? What is the matching concept? Okay, a nice effort she has made and she has tried to answer. So it was a really a great thing that she has shown the courage and she has answered the things. So congratulations to you. Now, matching concept and dual and relation has one reason. Now we have seen though in accounts every A has equal every B. We have seen the two transactions. One, a person is selling the goods and getting the money. Second, person is purchasing goods. He is also getting discount and he is sending money. So in accounts, every debit and every credit relation amount is matched. There are two types of discount in accounts. One is a cash discount and second is a trade discount. The cash discount is given for getting your payment early, whereas we record the trade discount because it is given on quantity basis. For example, instead of 1 kg, I buy 1000 kg. Instead of one banana, I buy 1 dozen banana. Instead of 1 liter, I buy 50 liters. Instead of one egg, I buy 1 dozen egg. The prices will change. The change in price because I'm getting some goods in bulk So when change in price due to the bulk quantity, it is called as a trade discount. Trade discounts are not recorded in the books of accounts because they are indirectly recorded in settlements. Whereas the other discount is a cash discount. The cash discount is given for reducing your collection period. It means earlier customer used to pay after 10 days, but I will offer him that if you pay me in 5 days, I'll give 5% discount. So in case the customer delighted by 5% margin, he will just think I have to pay anyhow after 10 days. So why not 5 days? And if I'm getting a discount, he will additionally emphasize himself for that discount. The matching principle ensures that all income is equal to expenses. It ensures that when I'm writing the accounts, I should analyze and check whether the expenses of revenue or capital or deferred, they have exact similar expenses or income. If income is 1000 on debit side, the reason should be given on credit side 1000. But if instead of 1000, I received 500, it means I receive only 500 and 500 is still to be received. So as per this concept, whether you received or receivable, whichever is the first day, you should record the books of account. Secondly, suppose you're supposed to receive 500, but you just received 100 and 400 is outstanding. So that record has to be maintained as outstanding receivables. And we write it on asset side and we mention in P&L accounts. Whereas, suppose I have to meet and pay the expenses. For example, I need to pay the wages in a year 60,000. So 60,000 for 12 months, it means 1 month I am paying 5,000. If suppose 10,000 wages are unpaid, it simply indicates 2 months I am not paying. But as per accounts, if you have due date, it means you need to pay. So whether you pay or paid or payable, whichever is first, you need to put that record and maintain the accounts. So as per this concept, the every income has equal expense effect, every debit has equal credit effect, and we understood something called as a prepaid and outstanding by analyzing the same accounting period. So as per matching concept, my one entry in accounts is equal to the other entry. I just cannot mention the single entry accounts. Single entry accounts are allowed for some sole proprietorship, but for overall, the people needs to follow the accounting principle, accounting logic, and understand the effect that is A equal to B, income equal to expenses, debit equal to credit. Now, let's say example. The first example is salary paid in 2012-13 for year 11-12. If the salary was payable in 2011-12 and it is not paid in 11-12, instead of we are paying in 12-13, it means it was outstanding in that financial year. So it is almost in 1 minute. So just quickly revise what you learned. Today we have started with accounting period concept. So 12-month period is followed in accounts for maintaining the books of accounts. We have revenue, deferred revenue, and capital expenditure based on number of days. Then we talk about cost accounts. So the cost concept, as per this concept, every transaction's cost is ascertained on particular level, and that ascertainment is done inclusive of all. And again, this is classified based on period. Then we talk about dual aspect concept that every transaction has double effects. Then we learn about the realization concept. As per realization concept, the value, the amount the people are paying for certain transaction. E is the value of realization. So that's all for today. Your next session is scheduled at 8 p.m. for the finance and at sorry 8 p.m. For the finance. Now you will have a common session for strategic management. Now you can log out from this meeting and join the next session. Thank you.